Well, good morning. This is Michael DeVille in sunny, beautiful Scottsdale, Arizona. It is July 7th, 2017. It's a stunningly gorgeous day as always here. The golf courses are open. The mountains are beautiful. It's green. It's lush. A little hot, but it is July. It's dry though, so we still love it here. Listen, a couple things I want to bring to your attention. We've been talking a lot about reducing exposure into the stock and bond market. We've been going reducing exposures for 18 to 24 months. I've been advising clients to transfer their funds from financial assets into real assets. We have had a stunning portfolio increases in our portfolio. We've just done exceptionally well. Plus, we're driving cash flow. Our cash flow has probably doubled over the last couple of years, so we're really, really pleased with that. And we're here in the number one county in America, in Maricopa County, which is geared for the next 10 years for growth. So that doesn't hurt. We've been very, very strong with our selection in property, so we're really, really pleased about that. And we've grown our clients' wealth substantially. But we're still pounding the table. We realize that 70% of the wealth in America is held in equities. I've been talking over and over and over again that life does not go on a straight line. Life goes in a cycle, that things come to an end. Bad times come to an end. Good times come to an end. So we have to make sure that we understand that we want to reallocate our funds. So I work with an awful lot of pension funds. So I work with a lot of people my age. I'm in my 60s. We do not have time to regrow our wealth. We want to start using some of our wealth and start having some fun in our life and start relaxing a little bit. So our time for should we take any kind of losses is finite. So we are very concerned about having a store of wealth. And of course, we're transferring into real things, real assets, real things. The commodity cycle really has taken a tremendous hit. You can see that oil and gold and iron ore and copper. These prices are hugely down, and they seem to have bottomed. So once you get into commodities as starting to bottom, we start thinking, well, okay, we're willing to put some of our assets into that. And of course, what a better asset than housing? I mean, houses are made out of every one of the commodities there is. So if the commodities start going up, well, we pretty well expect that the components of a home will certainly go up. Plus, we have a demographic push here in Maricopa County and Phoenix. It's just been really, really wonderful. I mean, we do a tremendous asset allocation anyway and get really good properties, and we're very, very careful about what I buy. So we have really, really come down onto the risk level, and we are down into really, really conservative things, buying only things that are what you would call affordable housing. Affordable housing is a problem all across the country. So we're buying those things that everybody can buy, everybody can afford. And if we have any kind of recessionary event, why people will always be able to lease these. So we're really protecting our money. And as such, we've done very, very well. Some of the upper ends, of course, all across the nation, in luxury homes, those prices have come down. You can see that in New York, San Francisco, Miami. Silicon Valley, of course, is taking trouble. All the high end is really starting to have some major trouble. But the entry level, where people really just where the millennials are going to be coming into, it's just done exceptionally well. And we've been focusing our purchasing on that, and we have been greatly rewarded. However, this is a warning. I deal with an awful lot of people who have pensions, retirements, direct deposit IRAs, some family wealth. And this is for retirement funds. So we talk about things that we were very, very conservative with, very, very safe with. But what I want to direct the conversation today is that the 70% of the wealth of America is still held within the equity markets of the United States, 70%. They are a typical 7.5 years cycle. They're 9 years into it. They're getting very, very tired. We've been talking about this for the last year and a half. We have cycled an awful lot of assets out of it. It's time to reallocate. So those of you who still have your money in the stock and bond market, the stock market has done exceptionally well. Keep in mind, you do not have to be 100% invested at all times. It's just not necessary for you to do that. So talk to your advisor and say, look, there's red flags everywhere. I mean, everywhere you look, there's a red flag. If we have any kind of trouble across the nation, why we could easily slide into recession. We've had things that look really, really good, but we have such confusion on the statistics. You know, if you talk to some of the bankers, they say everything is wonderful, but you look at the retail stores. Last year we lost over 800 stores, and everybody was saying, "Oh my gosh, 800 stores closed." We're looking at almost 9,000 this year, so we're talking about 12 times what went on last year, and Sears is going to go bankrupt. So, you know, and so things are not as rosy as people say they are. So let me just say there's some red flags. So you do not have to be invested. Take some money off the table. We've been talking about reallocating into better marketplaces like we have. We are so fortunate here in Scottsdale and Phoenix and Peoria, here in Maricopa County. I mean, last year we had 85,000 net people come here, and we only built 21,000 units. So we actually have a shortage here. If you can believe that, there's bubbles around the country. We have a shortage of rentals. We have a shortage of property. So it's been really good for us. So we're looking forward to that. So that's the type of things that we're extremely conservative. So keep this in mind. In just a normal correction, just when you enter a bear market, you lose 25% of your money. If you go into recession, just a normal recession is like 35%. Who can afford to lose 35% of your money at our age? So please be careful. Here's a couple things too, just things that have come across, is that the Federal Reserve is withdrawing liquidity. They're no longer going to support the stock and bond market. So that means that they're going to be withdrawing $10 billion a month for the next 3 months. 20 billion the next 3 months after that, and 30 billion for the next 6 months after that, to 40 billion after that. So 90 billion this year, 510 billion next year. So look at the wind is coming out of the sails for the stock market. So I'm just putting this out there. We've been talking about. We said it's going to happen, and we've been preparing for it. If you're not prepared for it, you're going to get creamed. So you really need to think about this. And keep this in mind, too, that when you have bonds that are at a 5,000-year high, because interest rates are negative, well, they bottomed, and now they're on their way up. So anybody that has bonds, you're going to lose money. So when you hit a bottom of 1.6% for a 10-year, that's typically and normally 5 to 6%. Well, that's a long ways up. It's a huge loss. So they're already up around 2.3. So that's a really big move. In Europe, they've off the negatives up to a quarter to half a point. One say, well, it's only half a point. But it's double from where it was 6 months ago. No one talks about that. And it could double again. So the world of low interest rates are over with. So we want to get into something that's fixed rate. We're very, very conservative with our money. We work with pension funds. We work with sacred money that you want to keep forever. So we're talking that I think, you're welcome to call me, and we're more than happy to talk. You can talk to my staff. But here's where we're at. We think that we have a safer store of wealth, safer. As we learned in 2008 and 2009, we can go down too. We think that we could correct, but it'll be safer than leaving it elsewhere. Keep in mind too, direct ownership of real estate has extremely low correlation between direct ownership and Wall Street. So you can have turmoil on Wall Street and not necessarily have problems with yours. Of course, if we hit into a recession or worse, we're gonna affect it. But we're looking longer because we have an 18.5-year cycle, and we're midstream. So I'm not too terribly concerned. We could have some turmoil, but we're going to earn cash flow and get money coming in more than what you're making in the stock and bond market. Our cash flow is excellent, and we're growing it. And we're in a growth market. So I feel pretty comfortable about that. There's also a demographic bomb that's, we've talked about this for years. It's coming to roost. 10,000 baby boomers every single day retire. And once you become a baby boomer and you retire, what do? You start taking your money out of the market. So you've had 40 or 50 years of stuffing your money into the stock market. Now you're taking it out. So now the Federal Reserve is going to take their money out, and the baby boomers are. So, and we're getting to the point where a lot of us are turning 70 and a half. Well, at 70 and a half, you get the minimum required distribution. You have to take at least 5% of your holdings out of the stock market. Well, okay, so, to leave your money in the stock market when you have turmoil in the world just doesn't make sense. And it's a liquid market. You can take half the market off, half your money off the market. You're welcome to call us. We're here to help. We're fiduciaries, so we're used to dealing with money. So, listen, I'm going to wish you the very, very best, and let's stay in contact. You're welcome to call me. See you guys. Best to you all. Bye bye.